U.S. pension funds are quietly losing billions of dollars, and most Americans will not realize the impact until it is too late. China has recently made a massive $8 trillion economic move, and this shift is sending subtle but powerful shockwaves through global financial markets, including the United States. While these developments are largely ignored by mainstream media, they are already affecting pension funds, institutional investors, and anyone relying on long-term investments. This $8 trillion move by China is not just a large number or an abstract statistic. It represents a fundamental shift in global liquidity and trade flows, which indirectly impacts bond yields, equity markets, and the overall stability of financial investments in the United States. Even small fluctuations caused by this move can have ripple effects that accumulate over time, quietly influencing trillions of dollars in investments. Pension funds in the United States, which collectively hold trillions in bonds, equities, and other financial instruments linked to international markets, are particularly vulnerable. Early signs of impact are already visible in subtle changes to bond yields and asset allocations. These changes may seem minor on the surface, but when considered at the scale of these large funds, they translate into billions of dollars quietly being affected. It is important to understand that while the mainstream media and general public may overlook these developments, the consequences are real and significant. Retirees, middle-class investors, and anyone relying on pension funds or bond investments may be unknowingly exposed to these shifts. Small adjustments in global liquidity and market trends can accumulate, affecting dividends, returns, and long-term financial security. In this video, we will carefully analyze the details of China's $8 trillion move, show exactly how U.S. pension funds are being quietly impacted, and reveal the micro-signals that most ordinary investors do not notice. By paying attention to these details, you can better understand the hidden risks and take steps to protect your financial future. U.S. pension funds invest heavily in global bonds, equities, and other financial instruments. These funds collectively hold trillions of dollars, and even minor fluctuations in international markets can create ripple effects that impact returns for millions of Americans. While small changes in global liquidity might seem insignificant, at the scale of these funds, they can quietly translate into billions of dollars moving in and out of investments. China's recent $8 trillion move has triggered subtle shifts in bond yields and market allocations, which directly affects the performance of U.S. pension funds. Some of the largest pension funds are already seeing early signs of losses, though these changes are not immediately apparent to ordinary investors. Regional banks are adjusting their portfolios quietly, hinting at larger ripple effects across the system that could affect retirement income, dividends, and overall fund growth. It is crucial to recognize that these changes are gradual but impactful. Small percentage shifts in bond yields, when applied to trillions in holdings, result in substantial financial consequences. For retirees, this could mean slightly lower payouts each month, and for long-term investors, it could reduce overall returns over the years. These micro-impacts often go unnoticed, because they do not appear in the headlines or mainstream media reports, yet they are very real. Monitoring these subtle trends requires attention to multiple data points, including bond yield movements, fund allocation adjustments, and changes in banking and treasury activities. Investors who understand these micro-signals can better anticipate potential risks and take steps to protect their savings. By paying attention to these details, you gain a clearer picture of how large-scale international financial moves, such as China's $8 trillion adjustment, quietly influence U.S. pension funds and the financial security of ordinary Americans. While most investors focus on headline news and obvious market movements, there are several hidden signals in the financial system that are often overlooked. Corporate debt in the United States is quietly rising, and many companies are adjusting their financing strategies without drawing attention. Treasury auctions, which may seem routine, have revealed subtle shifts in investor behavior that indicate changes in market confidence. These micro-changes are critical for understanding the hidden risks affecting U.S. pension funds and other large investors. Regional banks are also quietly adjusting their portfolios, modifying loan exposure and investment allocations in response to changes in global liquidity. These adjustments may seem minor individually, but collectively they create early warning signals for larger market movements. Ordinary investors rarely notice these signals, which makes them even more important to track. Paying attention to bond yield fluctuations, corporate debt metrics, and regional banking activities can reveal patterns that are invisible to the mainstream media. Many retirees and middle-class investors are unaware of these developments, but the cumulative effect can significantly impact retirement, income, and fund performance. For example, a small 0.25% shift in bond yields, applied across trillions of dollars of holdings, can result in losses of billions, quietly reducing dividends and long-term returns. Recognizing these microtrends early is essential for protecting your savings and maintaining financial security. By monitoring these hidden signals, investors can anticipate risks that are not obvious in the headlines. Subtle market adjustments, when compounded over time, can lead to larger financial consequences. Understanding these hidden forces allows you to make informed decisions, adjust investment strategies, and reduce exposure to potential losses. In the next section, we will summarize the key takeaways and provide practical advice for protecting your money against these silent financial shifts. The key takeaway from China's $8 trillion economic move is that U.S. pension funds are quietly being affected. Most ordinary Americans are largely unaware of the full impact of these changes. While Wall Street insiders monitor these developments closely, retirees and individual investors may not notice the early warning signs. These subtle changes can accumulate over time and influence dividends, long-term returns, and overall financial security. Understanding microtrends in the market is critical for anyone who relies on pension funds or bond investments. Paying attention to small adjustments in bond yields can provide early signals of potential risk. Changes in fund allocations by large pension funds are also important indicators. Corporate debt metrics reveal shifts that could quietly impact investment performance. Regional banking activity is another key factor that affects pension funds. Even small fluctuations in these areas can result in noticeable financial consequences over time. Investors who understand these micro-trends are better positioned to anticipate market shifts. Early detection allows for proactive adjustments in investment strategy. Retirees and middle-class Americans benefit the most from monitoring these subtle changes. Ignoring these signals can result in unexpected reductions in income or returns. The combined effect of multiple micro-adjustments can be significant. These hidden financial risks often do not appear in mainstream media coverage. Awareness is the first step toward protecting your financial future. By tracking bond yields, fund allocations, and debt metrics, investors can spot early warning signs. Understanding the implications of China's $8 trillion move helps investors make informed decisions. It is also important to recognize that market trends are interconnected globally. International economic moves can silently affect U.S. pension funds and investments. Monitoring these trends ensures that you remain informed and prepared. Proactive investors can adjust portfolios to minimize risk and protect capital. Ignoring subtle market signals leaves investors vulnerable to hidden financial shocks. Being informed allows investors to respond quickly to changing conditions. Adjustments in investment strategies based on micro-trends can preserve returns. Awareness of these hidden signals is crucial for long-term financial planning. Tracking small shifts in liquidity, yields, and bank activity provides a competitive advantage. Ordinary investors who stay alert are less likely to be caught off guard. Pension funds, dividends, and bond returns are all affected by these micro-changes. Consistent monitoring of the market helps identify emerging risks early. Early action can prevent minor shifts from becoming major financial setbacks. Financial security depends on understanding both macro and micro trends. China's $8 trillion move serves as a reminder of the interconnected global financial system. Staying informed is essential to ensure that retirement funds remain secure. Investors who pay attention to micro signals can make better long-term decisions. Following subtle market trends allows for timely adjustments in portfolios. Subscribe to this channel to receive regular updates on hidden financial risks. Staying informed, analyzing micro trends, and paying attention to small shifts gives you control over your investments. By understanding these silent market movements, you can secure your financial future and protect your retirement income.